Okay, let's call the meeting to order. Let the record reflect that all members are present. And we would like to welcome Gerard to our group now.
Thank you.
It's nice to
Pleasure
have
to
you
be here.
officially sitting here.
Thank you.
Welcome. Next scheduled meeting, December 17th. That's good with everybody?
Yep.
And we do 8:30. Do we have any citizens' comments on agenda items? We don't seem to have any citizens here, so I guess not. Approval of the minutes from the June 18th meeting.
So moved.
Second. Motion made and seconded. All those in favor signify by saying aye.
Aye.
Motion approved unanimously. Okay, next is reports, and we're going to move Templeton. Are you on the call, Templeton? Okay. Guess we're not going to move them. Oh,
They should be joining at 8:30, and I just want to ask that you guys, when you make motions, state your names, because I can't see with the mask, and I'll be watching from a different room.
okay.
And they, Carrie, if you
Is
want.
it better for me to go there versus here?
Yes.
Okay.
Good morning, this is Brian Cayley from Franklin Templeton.
Hey, Brian, good morning. It's Carrie Richardville, and I've got you on the line with the board from Punta Gorda Fire. How you doing?
I am doing well this morning, Carrie, and good morning to you and everybody on the board.
Great, thank you. So board members, I just want to let you know, Brian Cayley and Jason LaRocco will be joining us from Templeton in regards to the global total return strategy. Brian and the board, what I'll ask is that you give the board some insight into your pre and post COVID positioning, talking about some of the underperformance and then what your outlook would be going forward and your current positioning, with some time allotted for Q&A. And Brian, too, just want to let you know, because of kind of the logistics these days, we've got someone taking minutes remotely. So if you and Jason could state your name before you speak, that way she can kind of capture the correct speaker, that would be great.
Sure, not a problem. So, should we just jump into it, or did you all have something you needed to go through first on the agenda?
We are actually ready for you all. We just did minutes approval, so you are actually the next item on the agenda. Whenever you are ready, we are ready.
Okay, great. And just time-wise, how long should we take? 15, 20 minutes total with some time for Q&A, or?
I think that sounds
what do you
about
think?
right. Yes, Brian, that would be great.
Okay, perfect. Well, yes, this is Brian Cayley. Good morning, everyone. Thanks for having us in today. Really appreciate the opportunity to give you an update on our global total return strategy. Just for quick background on myself and Jason, I am a relationship manager for Franklin Templeton's institutional team. I'm based just across the state from you in Fort Lauderdale. So nice to meet all of y'all over the phone today. Jason LaRocco, who is joining me on the phone, is a portfolio specialist for our global macro team, and Jason's based up in our New York office. Yeah, we'll stick to 15, 20 minutes. I know y'all have a busy agenda, but we'll certainly take as much time as needed to address any of the questions you have. And I guess I'd also like to say I hope that everyone that we're on the phone today and all their families have been safe and are doing well during the pandemic. Like a lot of companies around the world, Franklin Templeton has been working remotely since March, and has actually it's gone fairly smoothly. I think better than anyone could have anticipated, though. We have had a lot of practice at disaster recovery situations, particularly here in Florida, dealing with hurricanes, and our headquarters is actually based out in California. So in addition to the pandemic, it's dealing with wildfires and then the occasional earthquakes. So, we've had a lot of practice at this, unfortunately, but again, everything's gone smoothly, and the team has been able to manage your portfolio without any problems. So I trust everybody has a copy of the presentation in front of them. So I'm just going to highlight 2 quick pages here before I turn it over to Jason. Starting on page 5, this is an overview of Franklin Templeton, and we had a pretty significant organizational announcement this year. Franklin Templeton acquired another large asset manager, Legg Mason. The deal closed on August the 3rd, so we are officially a combined company now that manages $1.4 trillion in assets under management. And on page 5, you can kind of see the breakdown of fixed income, equity, and then some of the other specialized asset classes that we manage. But we're really excited about the combined organization. It helps diversify our asset base. For Franklin Templeton, Legg Mason provides a number of new strategies that fill in gaps in our lineup, so to speak. So really excited about the future of our business and the company moving forward. On page 7, this is kind of a snapshot of the Templeton Global Macro Group, which manages your portfolio. I mentioned the acquisition and the combined company, but I can assure you that there has been no changes made to this team. The team is one of our larger and more successful teams in the Franklin Templeton organization. The team manages an aggregate $73 billion in client assets and has been managing global fixed income going back to 1986. And our team, the Templeton Global Macro team, approach to managing global fixed income is more of an unconstrained approach, kind of go anywhere, do anything, and take advantage of inefficiencies in the market. So we do have a long, successful track record. The Templeton Global Total Return Fund falls in the second square there in the circle, which is our global multi-sector strategy. So we manage $23 billion in assets in this strategy. And just maybe to set the table for Jason, as he kind of gets into the details of the portfolio, coming into the year, we had been positioned more defensively, not anticipating a pandemic, so to speak, but just kind of where we were in the cycle. So during the drawdown in February and March, we actually held up relatively well compared to a lot of our peers. We maintained that defensive positioning during the second quarter. And so the result of that was we didn't participate as much in the rally, and we continue to maintain the defensive positioning just given the uncertainty around the recovery, when a vaccine will be available. But we think we are well positioned to take advantage of opportunities as they present themselves as we kind of work through the issues, not only as regards to the health of everyone and finding a solution for for COVID, but as the market kind of shakes out and we think we'll be able to take advantage of these opportunities. So maybe with that, I'll turn it over to Jason to kind of get into the specifics of the portfolio.
Okay, thank you, Brian. This is Jason LaRocco. Good morning, everyone, and I appreciate the opportunity to share the update with you. Maybe just if I can ask you to jump to page 11, I'd like to just take a minute to expand a little bit on what Brian was mentioning about our approach. I just think it's important to underscore these key tenets of our philosophy. The first being we have always taken an unconstrained worldview, which basically means we don't limit ourselves or constrain ourselves based on what the index looks like. So we've always tried to take an approach where we break down barriers in terms of borders, go anywhere around the world, build a portfolio where we have the highest convictions and irrespective of what's in the index. But it's very actively managed. We strive to make sure every risk in the portfolio is recognized and intentional. But when you take a very active and flexible approach like we do, you have to certainly do the research. So we have a team of research analysts. Most notably, I would highlight we have several PhD economists on the research side, looking at all various countries and regions, and we really want to understand countries intimately. So we want to know what drives the economy, what the political environment looks like, the history of a country. And it's a very eclectic group. We have 14 different nationalities represented across the team in total, and there's 18 different languages spoken. So there's diversity of mind as well. So we want to not just understand things analytically, but culturally. And then finally, it's high conviction. So we try to think out over the longer term. Our skill set is not short-term trading. We're trying to figure out what the big shifts will be, where we think the world is going, and then combine that with the most compelling opportunities we're finding from our research. So oftentimes we are taking a contrarian view that's different than the general consensus. It's not just for the sake of being contrarian. We want to be comfortable being contrarian, but we are willing to weather periods of underperformance. Typically that's when we're finding our best ideas, and then that's driving big outperformance, and the patience gets rewarded, and that's driven our long-term track record. So with that, to talk about positioning pre and post-coronavirus, if we jump to page 29, these are just the calendar year returns on the strategy. I do want to recognize we've had significant underperformance year to date and underperformed last year. But I do want to note, if you just look at the longer term numbers year by year, we've been pretty consistent at outperforming the index or maybe being in line with the index, in some cases even not losing money, like in 2018 when the index was negative. But I would say the positioning, as Brian mentioned, we'll take a look in a minute talking about where we think we're going. But we came into this year a lot more defensive, actually the most defensive we've been in a decade. And again, it wasn't because we were predicting the coronavirus, but we did think a little over a year ago that markets were very vulnerable to any kind of shock. We were increasingly getting closer to the end of what they call the economic cycle in terms of more robust growth. We've been seeing risks pick up on the geopolitical front. We've been seeing a rise of populism and political polarization around a lot of parts of the world, just things that are going to cause a lot of uncertainty for markets. So about over a year ago, we started getting quite a bit more defensive with the majority of the portfolio. I would say one thing we got wrong last year and earlier this year was we did not expect the Fed to cut interest rates last year in an environment when the economy was doing well and we had a strong labor market. But they did that because of the trade tensions that were dominating and market volatility. So that caused some underperformance last year and also hurt us this year as interest rates collapsed and we weren't really positioned for that. However, the rest of the portfolio, we again held up very well earlier this year. So our returns during late February into March, we were down slightly, 3 to 4% compared to a lot of other.
Jason, are you still there? Brian, are you there?
I will get Sarah to come back. Sarah, if you're listening, can you come back and redial us?
Excuse me.
That one was weird, because usually it like cuts out, that was.
It literally
Yeah,
just
just
went
gone,
away.
yeah.
Yeah, I can say I've probably never witnessed anything like that. Really bizarre.
Oh, good.
Sorry, Leah, no idea what.
I wanted on meetings.
No, I can't imagine, especially not like a 13-minute one, you know?
Yeah.
Thank you.
Yeah, thanks, Sarah.
Welcome to the audio conferencing center. Please enter a conference ID followed by... If you're the meeting organizer, press star now. Please enter your PIN and then press pound. You are now joining the meeting as a leader.
So we think there'll be more dominoes to fall. So our positioning, just to highlight a few things, if I can ask you to jump to page 38.
Hey, Jason, I'm very
This
sorry to
summarizes-
interrupt you. Can you hear me?
Yes.
Our line went dead probably 2 minutes ago when we just called back in. I
geez.
apologize. Could we
That's okay.
could we back
I
up
heard
just a little
the
bit?
beats, but I didn't realize that that's what it was.
I don't know what happened, but all of a
so-
sudden we just disappeared. So I apologize for that.
No problem. Would you be able to tell me just the last comment that you heard before you got disconnected?
Page 30.
I'll just pick it up
Yeah.
briefly from there.
We were wrapping up on 30. The kind of just
Okay.
talking high level performance and.
Sure. So I think the best page to look at would be, I believe, 38. It should be, it says portfolio positioning around 4 pillars. And I was just mentioning that we're taking a contrarian view. Part of the reason we've underperformed is we've been adding into investments that we think will act as safe havens, and there's a lot of return potential in going forward because we think we're still in phase 1 of an ongoing crisis. We think as we head into the next 2 quarters of 6 to 9 months, we're going to start to see that job losses are much more permanent than the market expects. We think bankruptcies will pick up, and this is based on what's already happened with economies earlier this year. The spillover effects will continue, we think, for several quarters, and we don't think we'll see just a quick, sharp recovery, and this was only a 2 to 3 month crisis. We're not trying to speculate if there'll be a second wave of cases or a vaccine, but we're already seeing things level off in terms of economies. We're starting to see the job market disappoint in terms of numbers of unemployment claims. So we're maintaining a very defensive posture, and here's really the summary of the strategy and the value and how we think we'll claw our way back and have outperformance and diversify your total portfolio for this view and acting as a hedge for phase 1 of this crisis, which we think we're still in. The first component, briefly, it just talks about optimizing interest rate risk. What we mean by that is interest rates are so low on U.S. Treasuries. They're negative in Europe and Japan on government bonds. So the core fixed income that's worked well for you earlier this year, we just don't see much more room to go in those types of strategies to act as a hedge and offset if your stocks are selling off. Where we think we'll provide value with our, again, more cautious view is in that second piece, which is investing in safe haven currencies. So we have currency exposure. Again, that's a part of our opportunity set in the Japanese yen and the Swiss franc. We see a lot of return potential. We think as there's another shock to markets and a reality check, and markets have been too optimistic, market will seek out undervalued safe haven investments. And the Swiss franc historically is a safe haven, the Japanese yen. So we have these positions that there's a lot of return potential in, even with a cautious view going forward. And then we hold a lot of liquidity. So we are holding elevated cash. It's to be defensive today, but then we want to be able to take advantage of opportunities and add risk back in after we think we see a wave of bankruptcies. And then that's when we'll have a more sustainable recovery. So we do think things will get a little bit worse in the near term before they continue to get better. So we are defensive with the cash, but then we'll put that money to work to drive future returns and take advantage of opportunities. And then finally, the last component, we still have exposure to developing countries in Latin America, in Asia, ex-Japan, so like a Mexico or Indonesia. But it's very selective, very cautious. We're not taking currency risk in those countries. But the bond yields are more attractive than what you can get in the U.S. or, say, Europe or Japan. And so Mexico is a great example. We're buying government bonds today out to maybe 2 or 3 years maturity. The interest rates we're getting on those are between around 4 to 4.5% yield. But there's a lot more room for those rates to come down. So just thinking in the U.S. how our central bank cut interest rates to 0, in Mexico, the central bank rate is 4.5%. today. So they've been dropping interest rates. There's a lot more room to go. And these countries are also going through a crisis. So that income is important for return. We think those bonds could appreciate, again, as those yields are more attractive today. So these four components is really how we will navigate, we think, another market shock. And it could be driven from, again, the reality of where the economy really is, or maybe a geopolitical event. It could be any combination of shocks. But we are continuing to be defensive. So that's why we've underperformed. But we think we can really provide diversification. And when we get another bout of volatility, which we think is highly likely in the later part of this year, we're positioned to try and generate a positive return. So it's not just defending capital and protecting against losing money, but trying to actually generate a positive return when things could be selling off again like they were earlier this year, and your core fixed income may not be acting as strong as it did then. And then at that point, again, we will shift into taking more opportunistic positions. So I'm happy to pause there and take any questions that you have.
Questions, folks, but please state your name first so I can capture that. Anybody?
I guess, Jason, can you talk a little bit about some of the Argentinian exposure that weighed on the results at least a couple of quarters ago? Are you still kind of long that country in those positions? Has your outlook changed there?
Sure. So you can see that on page 40, the country exposure. So the first column is our portfolio. Argentina is a 3.4% position. It's always been a smaller position in the portfolio. It did hurt us last summer. This was a distressed position when we put it in the portfolio. It was positive at the time, a positive transformation a handful of years ago that we thought would play out. But unfortunately, in the environment that we've been going through over the last couple of years, we saw a return of populist politicians and a change in government. So that disruption caused some underperformance from that position earlier this year. We continue to monitor the developments there. It has helped, actually. It's been positive to the portfolio year to date. But we're not adding in. Again, things have changed. A lot has changed over the last year. So we continue to maintain that exposure, but it is a smaller part of the portfolio.
Thank you.
But I would say other positions have helped, again, like Mexico, Brazil with the bonds we own, Indonesia.
Questions, anybody?
Yeah, David Baird here. First, follow up on your Mexican exposure. You said you were getting yields of around 4% on Mexican bonds, maybe a little more, but you were not taking a currency risk. How much does it cost? How much of the 4% do you lose on hedging?
Sure. So with the hedging, the cost is pretty minimal because we are using what's called currency options. So the team is buying currency options to protect against big moves in the currency and hedge out that risk. So we are keeping about half, a little over half of that yield. But we are thinking that the bonds could appreciate as those rates come down further. So there's potential for capital gains on top of that attractive yield after the cost of hedging. And importantly, we are in a good position when we think maybe the Mexican peso has bottomed out and we don't see as much downside risk to just take those hedges off. We already own the bonds in the Mexican peso. So we can very quickly put Mexican peso exposure back on. And the benefit of owning those bonds that are denominated in pesos, even though we are hedging out currency risk, that's the domestic treasury market in Mexico. We don't want to be buying Mexican bonds that are denominated in U.S. dollars. There's no value there. Those markets are less liquid in times of stress because you're not in the domestic market with the institutions. You're trading with banks and regular investors in the dollar-denominated bonds. So we don't want that risk. We want to be tied to what the Mexican central bank does. So there's a lot more liquidity there. There's a lot of flexibility there in addition to more attractive yields even after hedging.
It's David Baird again. Can you, I guess one of the things that's been affecting emerging markets currencies particularly has been the US dollar denominated debt. And with trade tensions, et cetera, shifting supply chains, they're getting hung up on that kind of thing, and it's really significantly devaluing their currencies. Do you buy into that argument, or are there flaws in it?
Sure. So you can, if you do flip to the next page, that's our currency exposure on page 41, again in the first column. And I would note that we are hedging out the vast majority of our emerging market currency exposures. But importantly, it's very selective in emerging markets. We do have a cautious view. They're all going through a healthcare crisis on top of the disruptions to trade and the trade tensions and just the collapse in the global economy. So coming into this year, we've been focused on a very select subset of countries, and the team is really trying to find the countries that we think will weather the storm, the countries that have the more resilient economies, that have the more appropriate policies, lower levels of debt. There are some countries certainly that have a lot of dollar-denominated debt, but it's not every country in emerging markets. So country like Mexico has a much smaller amount of dollar-denominated debt, and it issues most of its debt in Mexican pesos. So it doesn't have that mismatch on the currencies. And again, the debt levels are manageable. So we're trying to think of countries that, again, have the means to stimulate, because they need to stimulate, that might be able to spend a little more money or run a bigger deficit or issue some more debt potentially, while avoiding the countries that we think will face stresses in an environment where trade is slowing down, supply chains are shifting, and that is a risk. Again, we're thinking about longer term, even after the coronavirus, in terms of we've seen a move towards deglobalization. Countries are turning more inward, becoming more nationalist. We're seeing, again, a rise of more populist politicians. And if countries are less dependent on each other, there's a risk for maybe a geopolitical event and maybe a military escalation somewhere around the world. So those risks are getting elevated at the same time. So we definitely think the next handful of years, the post-coronavirus world is going to look very different than the pre-coronavirus world, and we want to be able to navigate. So again, we're diving in really deep on these countries, and we're investing in and finding the ones that have the ability, we think, to weather these periods and differentiate themselves.
David Baird again. Question would be, the rationale for a lot of emerging market investments is that they're providing cheap labor. And with the degree of automation that's taking place, artificial intelligence, et cetera, a lot of these cheap labor advantages dissipating, which just removes the very rationale for being involved in these countries at all. Do you buy into that?
Well, there's definitely, that's been a big part of the globalization, right? So the trend of the less costly labor in those markets, and that, again, as you mentioned, with supply chains shifting. So we have to assess, for example, with the trade deal between U.S., Mexico, and Canada that replaced NAFTA. There were some stipulations in place that certain percentages of, say, auto parts needed to be made in the U.S. versus Mexico. So some of that supply chain then moved to the U.S. and becomes more costly. But then as a result of that, some of the supply chain that was previously in Asia moved over to Mexico. So we have to assess those changes. But again, when we go country by country, in emerging markets, technology is a big driver of those economies. So they've been able to, for example, move to, I think the best analogy is if you think of telephones. A lot of these developing countries, they don't have telephone infrastructure and phone lines, but they're going straight to mobile. So there's what they call technology leapfrogging. And we want to see what economies are maybe driven more domestically and might be less dependent on that cheap, I'd say less expensive labor and exporting, and countries that, what goes on in that country is a bigger driver of that economy and being less reliant on global trade. Mexico is certainly a big open economy and does a lot of trade, but its biggest trading partner is the United States, and we do think the U.S. has probably been one of the more resilient, bigger countries coming into this crisis. So they will benefit from our steady recovery over time. So these are all the things that the team has to think about. And again, there are some definite big structural changes going on that we're trying to assess how it's going to impact each individual country that we're looking at. There'll be winners and losers.
Anybody else? Questions? Anything else?
One more question. It's David Baird again. I'm sorry.
Sorry, go ahead.
One of the positive things, I guess you could say, about markets generally right now is the degree of pessimism that's out there and the amount of cash that's being held. It's on the sidelines. And it's perplexing, I guess, to a lot of people that are looking at hard numbers to explain why the market has been performing so well. But with that much cash on the sidelines, the question is there, you still obviously feel there's a lot of risk?
Yes, we do. We think that there's a misperception that central banks have solved. They'll just come to the rescue, and they've certainly done everything they can, and they did everything that we think was right in the near term earlier this year. But the concerns that we have about just assuming that central banks and governments will just print more money and that'll solve all the problems is that the political capacity, again, we think the next crisis is going to be bankruptcies. And we don't know what the solution will be to that, but we don't see countries having the political capacity to just keep throwing lifelines out, stimulus month after month. It will start to become unsustainable. We've already seen in the U.S., with stimulus, how it's getting hung up much more for additional rounds of stimulus. So that is a concern. There's a huge disconnect between markets and the underlying economies. There's fear of missing out. With the short-term momentum, and a lot of investors that we are speaking to, definitely feel uneasy. And there's a lot of things, even outside of the virus. We have the election. U.S.-China relations are the most strained they've been in decades. So there's a lot of things that we think can disrupt markets, and we can't point to one specific catalyst. It could be a combination of things. But again, we just feel very strongly that the markets are too optimistic more recently around the ability to solve these problems instantly. And then also, again, not embedding some of these other risks that can cause uncertainty into their forecasts.
Sorry, could I ask one more question? David Baird again. One of the things concerns me, and I wonder what your thoughts are on it, is, and I'm sure if it's happening in the U.S., it's happening elsewhere too. But for example, technically, anybody that looks at it, Illinois is bankrupt, Connecticut is bankrupt, Hawaii is bankrupt, Chicago is about to go bankrupt. We've had Puerto Rico go bankrupt. They are way overcommitted on pension obligations, et cetera, and there's no way for them to pay it. The other thing we're starting to see in some of these cities and even states is people getting tired of paying for it and actually moving out. We're seeing that in New York. We're seeing that in Los Angeles, San Francisco. So here are these big states and big cities with major amounts of debt outstanding that have no way possible of paying for it. And it's very easy for somebody to move from Illinois to Wisconsin. Is that a concern of yours?
It is. I mean, it just speaks to the concerns we have on the federal government side, just in terms of printing money. There's a lot of will there have to be bailouts? What's the political will to raise taxes, or can they constitutionally restructure some of that debt? Unfortunately, all these states are going to be put in an even worse position because the economies have collapsed and revenues have collapsed at the same time. And then, obviously, as you mentioned, those people are leaving. So we don't know what the solution is to that, but we do think that if there is any form of continued potential bailouts from the federal government, there's just thinking of kind of politically and the shorter term solutions has just been to print money. That just seems to solve problems, and it's not driving inflation. Just keep doing it, and we have a lot of concern of the money printing, just to use that to solve these problems in the near term. What the consequences could also be longer term as it relates to inflation. And again, it's not a concern right now, but there are some deeply rooted issues that, again, the can has been kicked down the road, or the political will isn't there in some cases to make the tough decisions, which just makes the problems worse down the road. So it's similar on the country. On the government side as well, of countries that have debt and are just printing money, it's been able to go on now, and it's politically popular if it's not solving the problems. But again, it makes it even harder to solve those problems down the road, and that is very concerning for us.
Thank you.
Any other questions? Well, thank you very much, guys.
All right. Well,
Thank you.
this is Brian Cayley. Thank you for your time today. We really appreciate your investment with us in our global and constrained fixed income strategy, and appreciate your patience as we've kind of worked through these issues in the market. And if there are any follow-up questions, just let Carrie know, and we'll be happy to address them. But thanks again for your time today.
Thank you for sharing your insights with us.
Thanks, Brian and Jason.
Thank you.
Did you click that off?
I did, yeah, and nothing is illuminated, so I think we're good. So basically, in summary, kind of what Jason and Brian were saying, Templeton, for many quarters before, call it pre-COVID, was actually negative duration, which means as interest rates rise, the price of their portfolio would actually go up rather than down. And they did have some significant EM exposures: Argentina, Mexico, Latin America. It seems to be a pretty pervasive theme for those guys. What we saw post kind of COVID, and really after, in conjunction with COVID and kind of the interest rate drops that we saw over the last years, they do have a positive duration position. They were completely absent U.S. markets for a long time. Now they've got, I think, something like 60% exposure to the U.S. So they've really changed their positioning very dramatically. And so, looking at this, we know how this team operates this portfolio. They've always been a high tracking error manager. Like they said, they're benchmark agnostic. They're going looking for the best ideas, the best relative value. They're really not even looking at how much of that it kind of is in the benchmark. They're just looking on an absolute basis for the best opportunities out there. But as our research group has been kind of talking to them and watching the underperformance recently, they took that kind of shift in portfolio as what they call kind of a capitulation of the trade. They had taken that very contrarian position, and then they kind of came off of that. And as a result of that, we have moved the strategy off our approved list. We still think they're a very strong, smart team. We just think they're so far behind at this point, it's going to take a long time for them to catch up. So I wanted to kind of give you all that update. That's very recent too, by the way, within the last 2 weeks. They've been on the bench for a long time, but the cost of that very unique positioning and complete absence from the U.S. market at a time when we got, high single digits out of fixed income just put them so far behind. We feel like now that they're, I'm going to use the term more kind of normally positioned, it's going to take them even longer to kind of catch back up from that performance. So I'm interested to know how you all kind of received the presentation, what your thoughts are about the strategy.
I would have been far more, I can understand them, let's say, making a bet on Brazil or Japan,
Yeah.
okay? and it hasn't worked out. It's gone against them. But they are sticking to their guns. They still believe what they originally did when they went in, and this is just a better opportunity, et cetera. So I could forgive them for that. What they're telling me, though, is they're sitting on cash.
Yes, a significant amount of cash, yeah. They're waiting to deploy that for the next.
So, I mean, it's not like they have a conviction about we ought to be in Brazil or we ought to be in Japan.
Yeah.
It's that, well, we don't know what to do, so we're sitting in cash.
That's kind of the vibe I get to be candid, yeah.
But this is also not a short-term disappointment. They haven't been doing well forever. I mean, we've been talking
Well, as
about the
their
numerous
last
times.
really great year was 2012. I don't think we were involved with them then.
We might not have been, yeah, but since then, it's just been a disappointment, so I'm glad we're making the move. We've talked about this several times, about looking at others and kind of,
Well, and as you've correctly pointed out too, most of what we've made with them had to do with currency speculation. And I think when you're investing in bonds, you're not expecting a high return, but you're expecting something that's going to be fairly steady. And instead of steady, we're getting good years and really bad years. Yeah.
yeah,
A whole lot of volatility,
more,
right?
more bad
That's
than
right.
good, yeah.
Yep. Okay, so I think then we'll plan to review the search book, which was on the agenda anyways.
Yes.
And I've got something in mind for you all for the space that I think will be a steady ride. So if it's all right, I'll proceed unless you'd like to do the search now. I can kind of go through June 30th in
Why
August,
don't we
or?
go through the results, because I think that might help us with what Templeton's been
Great.
doing to update
Okay.
us all.
So I will start with the performance report for the period ended June 30th.
Okay,
And I'll just make a few economic comments, flipping into page 2. So very interesting 2020 for, I mean, more reasons than we could probably enumerate right here, but effectively, we saw a pretty significant reversal from the pullback that we saw in the first quarter. First quarter, immensely painful. We entered the fastest bear market we ever had over the course of, 21 or 22 trading days, ending in March. S&P 500 down 34%. Nobody really knew, what does an economic shutdown look like? How do we get out of this? Lots and lots of valid questions. We followed that up with a period ended June 30th where, very much like Brian and Jason said, both the Federal Reserve and the government itself stepped in and put the PPP in place. We're, helping employers just to keep folks on payroll. We're using helicopter money or just mailing checks directly to taxpayers, improving unemployment benefits. And then the Fed, rode up alongside, dusted off their playbook from 2008, started participating in markets again, was buying treasuries, mortgage-backed securities in the markets, and then actually created even a new program to get involved in corporate bond markets as well. And as a result of that, markets were pretty happy with that news. And kind of to David's point about a lot of cash on the sidelines and what's going on in the market right now too. Another interesting anecdote, at least to me, was apparently a lot of millennials took their helicopter money and put it into the market. This kind of Robinhood app where you can buy partial shares. You see that with kind of some of the Tesla trading and stuff like that. So I think some of that type of activity may be contributing to the kind of the level of volatility that we're really seeing. But nonetheless, for the period ended June 30th, very strong rebounds in equity markets. Here domestically, if we were down 19.5 in the first quarter, we picked up a positive 20.5% in the second quarter. And interestingly enough, as you move down the capitalization spectrum, the smallest stocks did the best. So the small cap index actually did the best at over 25%. Overseas markets were also strong, though not to the degree that ours were, and for very similar reasons. They came out of lockdown. Europe came out of lockdown a little bit before we did. They kind of went through it first and came out of it a little bit ahead of us. But also central banks around the world are really supporting markets, and so that's kind of the theme. So call it 16% out of the all country, with developed markets at about 15% and emerging at about 18%. Likely largely due to the fact that actually China's been the shining star coming out of all this, if you can believe it. With their draconian lockdown, they were able to come out and kind of got back to life really better than any country through the period ended June 30. The Bloomberg Barclays aggregate posted a positive almost 3%. This was a quarter where the return there did not come from moves in interest rates. It actually came from spread tightening, and I'll show you a chart in a little bit, but basically, after the first quarter, spreads blew out, not a big surprise, meaning investors required more compensation for holding a credit security than a treasury. And you've seen that kind of come back in a little bit, and that's been positive for bond prices. Looking out on a one-year basis, the picture's still a little mixed through June with international indices down, call it a handful of percent. The S&P 500 is positive on a one-year basis, about 7.5%, but mid and small caps still negative. And the vast majority of that continues to be your FANG stocks. They really weathered March 31st nicely. We're kind of a safe haven, believe it or not, which was interesting to see. And so they've continued to really drive that segment where the others are kind of flat to negative still through June 30. And once again, kind of speaking back to fixed income, 8.7% out of fixed income on a one-year basis. I mean, if you missed out on that, you missed out on a whole lot of return there. Just very strong numbers for fixed income. The majority of that coming from U.S. governments at over 10%. And really that's the safe haven that they provided in the first quarter, but followed very closely by investment grade corporates at about 9.5%. Across the style series, I'm looking at the charts on page 3. Still extremely strong leadership by growth versus value. In kind of the 3000 index, which is large to small, almost kind of call it a 13% differential there in performance. For the reasons I said, again, FANG's really leading the way. And then on the value side, kind of some of the leisure names there and oil, other industries that have been under pressure are kind of not catching up or not keeping up quite as much with the growth segment. And then on a one-year basis, value across the board kind of negative while growth returns are strongly positive. I'll flip ahead in your books to 5 and just briefly talk about, there's some charts on 5 that I think are interesting. What we show on this page in the blue charts are the top holdings across the indices. And then in green are the best performing stocks. And I just think it's interesting because you can see the themes come through there. If you look at the green boxes of the best performers, names like Wayfair, Etsy, Overstock.com, folks shopping from home, Fastly, Bill.com, Workhorse, the working from home component in the coronavirus day. And then last but not least, Thor Industries at the bottom of the Russell 1000 box is a mobile home company. So one of the interesting phenomena we saw over the quarter was rental and purchasing of mobile homes really shooting up through this whole thing. If folks couldn't leave their house, they were going to take off and just bring the house with them. I will skip ahead just a bit. We'll finish economics on 9. The top right chart on 9 is a good visualization of that option adjusted spread I was telling you guys about. The light blue line in BAAOAS, so option adjusted spread, shows that kind of compensation that an investor requires between a treasury and a BAA corporate. And you can see it was kind of chugging along through the end of 2019 into 2020, call it 1.5%. And then you really see that spread blow out in February, March when we were kind of at the peak of the market panic, if you will. And then you see it trail back down, still elevated around 2% or 200 basis points as of June, but certainly recovered pretty significantly from the blowout that we saw in March. And again, that's where your returns came from in fixed income for the quarter. The bottom of page 9, the orange line was March and the green line was June as it relates to the Treasury yield curve. And you can see like basically no movement there, a little bit of a drop kind of in the mid part, but really no movement in interest rates over the quarter. And the Fed is really, this is probably not a surprise, but the Fed has come out and said, probably we're looking at another 3 years of near zero Fed funds rates. They want to see inflation at or above 2%, and they want to also believe that's sustainable for a period of time. So very likely we're going to be zero on the front end for probably another 3 years into 2023. Any questions on the economics? Just moving into the portfolio itself, I'll just flip to 10. So the fund finished the quarter with a market value of just over $16.5 million, with about 51.4% in domestic equity, 15 on the nose in international, 18.5 in domestic fixed income, 2.5 for your other fixed income managers, 10% for real estate, and just a tiny bit of cash as well. And if we flip to 12, from a kind of target asset allocation standpoint, where we are versus where we shoot to be, Everything close to target, so no need to rebalance. You're slightly overweight domestic equity. Not really a surprise after the quarter that we saw, and slightly underweight domestic fixed income, but everything very comfortably in line with your policy, so no recommendations for rebalancing. Getting into the numbers themselves, I'm going to flip to 15. For the quarter and on a gross basis, the fund did a 1791 versus a 1404 for the benchmark. On a fiscal year to date, that brought you gross close to 6.5, 648 versus a 415. And then looking out a bit for perspective, on a 3-year gross, that brings you to a 915 versus a 741 for the benchmark, and an 822 versus a 748 for the benchmark. Within your domestic equity segment, pretty strong performance from your managers, and also kind of the growth overweight has continued to help you guys, a 2677 out of that segment versus a 2203. There's that 20.5% for the Vanguard index. Wells Fargo growth, some of the Amazon, Apple names certainly helping out, but also some technology names like Market Access, which is an online trading tool, Twilio, some healthcare names, lifting them strongly over the index, 3471 versus a 2799. Dodge and Cox, just about 20% for the quarter versus a 1429 for the value index. We saw a nice rebound in energy. They've taken some selective positions there. So that rebound helped their names, Occidental Petroleum and a couple of others. Financial holdings as well, Goldman Sachs, and they've got some Microsoft as well, helped them for the quarter. Eaton Vance, 2221 versus a 2656, so fell a little behind for the quarter. They had zero energy exposure in that sector, in the small and mid-cap segment, did 50%. They also had some stock selection in consumer discretionary and healthcare that weighed on their results a bit for the quarter. Flipping into Euro Pacific on page 16. 2277 versus a 1630 for these guys. They have a heavy focus on e-commerce and luxury goods, so that certainly helped them. Also, good old technology. They pulled back on some of their industrial. They'd had some airline-related holdings, and they had recently kind of pulled back on that, so that helped them as well. Dodge and Cox, a 598 versus a 290. All that's coming from the overweight to credit. They have about 27% of the portfolio that's triple B right now, so that segment really lifting their results. Templeton Global Return, 36 basis points versus a 368 for the multiverse. Particularly this quarter, they had a short on the Australian dollar. They use the Australian dollar as a proxy for emerging markets because they do a lot of trading with emerging markets, and that trade didn't go their way this quarter. Credit Suisse, floating rate high income, 932 versus a 970, pretty much in line, but they had a 5% cash balance that was a bit of a drag. And then last but not least, Intercontinental, basically flat, -2 basis points versus a -127 for the index there. About 1% of that was income collection, about 85 basis points was a bit of market value depreciation there. Real estate is a space that we're continuing to watch as it relates to COVID. Certainly retail is kind of the first one that comes to people's minds. If malls and things are shut down, nobody's operating. Good news with Intercontinental is they have almost no retail. I think it's like 2% versus the index of 15. Things we are watching are things like multifamily, which are apartments. The collections were high through the second quarter, but keep in mind folks had their helicopter money and the unemployment benefits were extended. So that's something, were initiated. We'll see what happens from here. Those are things that we're watching. Office from a longer term is also something that we're watching. The leases are very long there, and the average lease that these guys have, tend to be 4 or 5 years out, and their tenants are very strong credits, like, some of them lease industrial space to Amazon. In particular, some of Intercontinental's largest tenants are Harvard Medical School and the state attorney for Massachusetts, things like that seems to be stable, but those are spaces we'll be watching in the future. There's been a lot out there about office and the future of office. Is office going to go away? And so again, we'll continue to watch those developments. I don't think office is going to die. I think the usage will change in the future. I think maybe there's more of a hybrid where folks work from home some and work in the office some. But I don't think office goes away. There's a lot of reasons why. I think you can't really have a company culture if you're completely online, I think. It's also very hard to train people. But not only that, over the last few kind of decades, the trend in office has actually been to use less and less square feet. So back in the day, you might have had 4 people per 1,000 square feet. Now it's like 6 to 8 because kind of hoteling and hot desking and all that stuff kind of came in. And probably you see a reversal of some of that. So I think that there's some offsetting factors in that space. But certainly something we'll be watching and continuing to keep you posted on. But again, basically flat Intercontinental versus a negative, call it 1.25% for the index.
Were you on their Zoom meeting?
I was not. I've seen kind of the literature, but
I was on the
when he and
meeting. I
Stanley-
was there the whole time.
Yeah,
And I have reason to believe that their future is very positive. In fact, if I had my druthers, I'd add to the position, not delete from it. The reason they came out flat is they wrote down the value of their real estate.
thank you for that.
And
They
they've done that
proactively
like
did that.
across the
That's right.
board. The other thing they are is way less leveraged than any of their competition. And so that's putting them in good shape. And I asked them basically whether are you more concerned given what's going on in cities being burned down and people moving
Yes.
out and this type of thing, or do you think there's opportunities? They think they're basically sitting on things right now. But they think there's a lot of opportunities that have started to arise because people are panicking. And they're sitting there with cash, and if they can get more cash, they think they're going to be in a position to really take advantage. And then you're going to see some considerable outperformance coming out of that.
Our real estate group feels similarly. They feel like this if we do see kind of some bumps, it's maybe a handful of quarters. They liken it the most to 9/11, after 9/11, because that was a safety issue too, really not like the leverage loans where that's just kind of financial, blow ups. 9/11 was kind of a health and safety issue too. But you didn't see people leave the city, stop working in the city, kind of things to that nature. And they kind of rode through it a couple of quarters and then some good opportunity presented itself. It's funny, with this space, probably like many, folks want to get their money out at the time when maybe there's a lot of opportunity to stay put. So I agree with you, David. I think we may have a couple bumpy quarters. The income seems to be stable, which is running about 4 to 5% a year. We may see a little bit of market value ding in the near term, but I think you'll make it back in the next couple of quarters.
I think personally they've already recognized it. They've been very conservative on marking down their properties. And so even if there's further erosion in the real world, it's not going to show up on their books. The other thing they did, which impressed me, because we were talking about in apartments, condos, offices even, the number of tenants that need relief or want out of their leases. And their approach is they are lowering the rents or lowering their lease costs down to a level which the tenant finds acceptable. And the quid pro quo is they're getting an extension in the lease. And what they've built in is a annual lease price increase, cost increase
Yeah.
for the tenant.
Yeah.
So the tenants are ecstatic because they're going to survive the downturn. They've extended term and they've built in like a period of an extra 3 or 4 years of growth. So, I think they've handled everything absolutely beautifully. And personally, if we've got the capacity to put more money into Intercontinental, I would do it.
Very good. We'll continue to watch the portfolio, and as it grows, if we've got the opportunity to do that, I support that as well. Any questions about 630, your managers, your performance, anything I can answer on 630?
No.
Okay.
Anybody?
I do have
Well,
an
I'd just like to
update.
thank them for the good performance.
Yes, no, I agree. I think they're one of the most capable and impressive managers in the space. And by the way, in case you find it interesting, they're also good humans too. They actually bought Pelotons. Did they tell you they bought
Yeah, they did.
Pelotons for all their employees?
Just
taking
they
great
gave,
care of them.
they gave
knowing-
their employees a choice, but they bought over 1,000 Pelotons.
It's kind of fun to work with good people too.
Yes.
So I thought I'd throw that out there.
Nice.
I have an August flash for you all, and I apologize. I think we're short some copies, but I'd be happy to distribute after the fact. Email or mail, whatever's easier for everybody. July and August continued to be very strong months in the market. So through the month of August, your plan picked up another estimated 4.25%. And that's without real estate, of course, because we don't get the intra-quarter valuations there. But as of August, that had your plan at about a 1565 fiscal versus a 1273. We've probably given a little bit of that back because there's been some volatility in September. But your plan market value as of yesterday is still about $17.7 million. So you're still on pretty strong footing from my perspective for a fiscal year standpoint. We just kind of have to cross our fingers and hold our breath that we finish strong, because we're close. We're, oh my gosh, less than 2 weeks out now, so. Any questions on that? And anybody that'd like a copy, let me know. I'll make sure you get one. I think last but not least, that leaves us to the global fixed income manager analysis. So we're showing you 3 managers today alongside Templeton that could be replacements. And I do want to talk a little bit about the space before I just jump right in. So when we say global, the managers we're going to look at today, much like Templeton, the one you have now, are really global multi-sector bond managers. And what I mean by that is a true global bond manager is going to go out and just buy sovereign bonds from other countries. A global multi-sector manager may look at EM bonds. They may look at, structured products in other countries. It's more of an opportunity set, if you will, because in the environment that we're in, plain old global bonds, you'd be squeezing blood from a stone. Kind of like, Brian and Jason were saying, Japan, Germany, some of the major issuers of debt out there are negative. There's just not, in the kind of global bond sovereign market, there's really not much to be had there. So the managers that we're showing you today are these kind of global total return multi-sector managers. About half of the kind of global population is U.S. debt, and the other half roughly is the rest of the world. So again, one of Templeton's kind of downsides is was not having U.S. exposure for a long time, but the extent of that U.S. exposure is going to have a big kind of impact on their near-term performance because we've had such strong returns out of fixed income. So just kind of wanted to put that out there. The options that we're showing to you are the Loomis Sayles Bond Institutional Fund. And Loomis Sayles, in my opinion, is kind of one of the best known names in fixed income. There's a guy named Dan Fuss that helps run this strategy. He's kind of one of the fixed income wizards of the world. Only downside there is he is 80 years old, so that's a consideration. Just something to say. PIMCO Diversified Income, another one of the kind of biggest, most recognized fixed income managers out there. And then a third called Brandywine. And Brandywine is a boutique asset manager. They operated independently for a while and then were purchased by Legg Mason, I think within the last kind of 5 to 7 years. And I want you also to know that as of July of this year, Brandywine and Legg Mason was bought by Franklin Templeton.
Right.
Now, the Brandywine team was always very independent. Legg Mason let them be that way, and we think that will continue under Franklin Templeton. But I do want to point that out to you all. They're going to roll up under that family. These are all mutual funds, much like what we have now. The fees, 67 basis points for Loomis Sayles' bond fund. 75 for PIMCO, 58 for Brandywine, and then the 71 that you were paying for Templeton. So pretty much in range, if not cheaper than Templeton, with PIMCO, the only exception slightly more expensive. Flipping into the managers themselves, I'll just go to page 4. Suffice it to say, the firms have all been around for a long period of time. Brandywine's the newest in 1986, but still basically 13 years old, or excuse me, 35 years old. I'll be all right. All of the strategies that we're showing you are 17 years or older. So these strategies have been in place for a while. They have long track records. Pretty much all of them benchmark either to a kind of a Govy credit or global credit type of benchmark. And that's one thing about this space I do want you to know is it's kind of challenging to benchmark because there are such degrees, again, to which they're exposed to the U.S. versus global. So some might consider themselves a U.S. manager with kind of a global allocation, and some consider themselves true global. So you see a little bit of the variation in the benchmarks they use. We use the Bloomberg Barclays Multiverse, which is basically global investment grade and then global high yield as well combined. Outperformance estimates, Loomis Sayles is going to shoot to outperform 3.5% to 4.5%. PIMCO's going to be in the 1 to 2% range. Brandywine's about 2, and Templeton doesn't list. And some of these you will find in some of the categories, they may not list targets because they are so unconstrained. Large strategies, Loomis about 38 billion. PIMCO, it's listed as about 4 billion, but I actually think that might just be a share class because this is a huge fund. 26 billion for Brandywine, and then about 40 for that Templeton fund. All of these funds, and I'm at the top of page 5, take a team-based approach. So on the Loomis team, there's 4 decision makers, same for PIMCO and several analysts underneath all of these strategies. 5 decision makers at Brandywine, and then at Templeton, it's Dr. Hasenstab and Calvin Ho, but several analysts. All of these teams have several analysts underneath them, and you can see that on the second to last line in the team information section. Again, these managers, because of the nature of the mandate and how heterogeneous they kind of are, if you look at, say, duration constraints, which is the 4th line under portfolio construction, pretty wide latitude in constructing these portfolios from an interest rate standpoint. Loomis Sayles is going to try to be plus or minus 5 years the duration of the benchmark. PIMCO is going to stay within a duration of 3 to 8 years flat. Brandywine's going to do 1 to 10 years, and Templeton does not give parameters for theirs. I think another good one to look at would be kind of region sector constraint. Some of them will give them, Loomis is only going to do 40% non-US dollars, but the rest of them really don't give themselves that constraint. Emerging markets, Loomis is only going to do 50%, but the others kind of leave themselves open. From a sector standpoint, Loomis Sayles is going to stick to 25% in one industry. PIMCO doesn't have any stated parameters there. Brandywine's going to do maximum munis 40%, maximum mortgage backs and asset-backed securities 20%, but still a lot of latitude there. And Templeton's only going to limit themselves to 25% in one industry too. The managers are going to be very diversified in kind of the bottom third of the page, total holdings in the hundreds to thousands. Just due to the size of these funds and kind of what they're doing, it lends itself to very diversified and lots of holdings. Maximum below BBB credits. Do want to emphasize this because again, they're going to use a significant amount of below investment grade credit to outperform. So Loomis is going to target between 20 and 50% below BBB. PIMCO manages the risk by limiting how much goes below single B, so they won't do 10% below single B. Brandywine won't do more than 35% below BBB, and Templeton's limit is 50. One other significant thing I want to point out is that with these managers, the sizes of the strategies and the exposures they're trying to achieve, almost all of them can use derivatives in their management. So sometimes when you're looking at kind of the portfolio data and trying to understand their positioning, that can make it a little bit more complicated to look through, if you will. But something worth knowing, Loomis is the only one that does not use derivatives in their positioning. Flipping ahead a bit to kind of how they do what they do, I'll flip to 6. And just kind of showing you the spaces that they tend to be in. In the bottom section of 6, sector allocation, kind of the biggest parts of Loomis's portfolio, corporate bond and government securities. PIMCO diversified, about 42% government, about 40% corporate, about 10% kind of agency, and then the rest is in other categories. But also you see they take active kind of long and short bets too. You can see their cash equivalents negative 38%. So lots of derivative use in the fund. Brandywine predominantly in government, call it 46% in corporate bonds like Loomis, similar positioning. And then Templeton, almost 2/3 in governments, though they're all over the world as they mentioned, and then that roughly kind of 1/3 there in cash. Looking at credit quality, and this is just as of June 30th, so just kind of a snapshot in time. 31% kind of AAA for Loomis, with the second largest exposure being BBB. Similar for PIMCO diversified, kind of 30% AAA, 27% BBB, with the rest kind of dispersed elsewhere. 19% AAA for Brandywine, and then they have significant pieces kind of in the A BBB section, and that's really where the majority of their assets are. And then call it 37% AAA for Templeton, and then a significant 30% BBB too. Just kind of giving you an idea of how they approach the credit spectrum, at least at June 30th. Flipping to page 9, Loomis sales, tending to be, call it kind of 80-ish% US. And then as far as developed and emerging, which is in the bottom of that kind of section, kind of 90-10 roughly, developed versus emerging. PIMCO diversified, 67% US exposure with kind of an 80-20 split between developed and emerging. Brandywine, about 50% US exposure, and then about 2/3 developed, 1/3 emerging. And then Templeton, kind of 30% US, which is up from basically zero. And then kind of more than half emerging markets there. So you can see that's where they're really kind of taking all their risk and making all their bets. Flipping into the quantitative section on 11. You can see on a 1-year kind of short-term basis, all the managers kind of struggling with the blowout of credit spreads in the first quarter and varying degrees of US exposure. Templeton certainly being punished for their lack of US exposure. But if you kind of look across all of the horizons, PIMCO diversified income really kind of stands out. They have a very kind of steady allocation, at least historically they have. They've kind of stuck to roughly 1/3 corporate bonds, 1/3 global bonds, and 1/3 high yield, with a very risk-controlled kind of focus. And so as you kind of look out on the longer term periods, PIMCO diversified kind of jumps out across the page. And I think the thing that I like about them as well is they tend to be kind of your most consistent manager. If you look at page 12, you can kind of see the very volatile performance pattern of Templeton, kind of to our earlier discussion that in years like 2012 and 2018, they did very well, but when they kind of fall behind, they fall way behind. But Brandywine tends to be kind of a more high tracking error manager as well. And if we flip to, let's do 20 and 21, kind of risk adjusted performance measures. I'm going to use on a 5 and 7 year basis because I think those are pretty reasonable timeframes. When we look at these pages, we want the bookends, standard deviation and tracking error to be low, and we want the middle 3 categories to be high. And you really see kind of for the most part, that diversified income strategy from PIMCO adding a lot of value with a little volatility as compared to their peers. And that's really kind of the strategy that I think would be a better fit for your portfolio. I think that's an extremely talented team and a deep bench. PIMCO manages over $1 trillion. They have boots on the ground all over the world. And I just think, it's kind of a good combination of value add, but also a much smoother ride than what you saw with Templeton.
I looked at these 4 on Morningstar because I like to use Morningstar, and I came to the same conclusion. Out of all of these, they are certainly the 10-year, for 10 years out, by far top performer. And their risk and reward, Loomis is an average risk and below average return. PIMCO is average and above average. And the other 2 are below average returns. One is high risk. Brandywine is considered high risk.
And because it has a value, that strategy, they're looking at real rates and kind of value, and that can take a while to kind of come into favor. And so I think they haven't been kind of in favor recently, but I just, I think coming off the ride that we've had with Templeton, I think just kind of a steady, reliable performer like a PIMCO is probably the best replacement for trying to get off that ride as much as you can in this space.
I mean, you look 10 years, you look at 10 years, that's a pretty long time, and they've certainly outperformed the others. And they're 4-star rated, so I'm in line with you. I think that's a good strategy. Other comments, folks?
Question, I don't know whether it's even possible for a pension fund, but I was listening to a portfolio manager talk about Chicago going bankrupt. And his entire fund is positioned to take advantage of that. They're short all
They short munis? Is that
Chicago
what
debt,
they
yeah.
did? Okay.
I don't know whether they got puts or whether they're, they just actually shorted it. But when Chicago declares Chapter 9, they're going to be very rich.
Wow.
Is there anybody doing that type of thing?
Not that I know of, but I would be happy to ask.
And I don't know
Yeah.
if that's eligible for, does that count as a bond fund if they're doing that?
Yeah, that's a great question. Yeah, that's a great question.
Interesting.
I mean, just for interest, I'll look. I'd be interested to know.
Yeah.
Smart.
I think PIMCO's kind of like the Dodge and Cox of bond world. They really are stellar in what they do. And they've been around forever, and they're kind of almost like the gold standard in bonds.
I
If
think
you're going with bond, you're, all right, PIMCO.
Yeah, but that was due mostly to the one fellow who's left.
Correct.
Yeah.
I know.
Bill
He
Gross?
was there
Yeah.
forever and ever and ever and ever,
Yes.
and he was like the rock star of the bond world for decades.
But he's been gone for a while now,
He's
right?
been
You know
gone
what's
for quite
funny?
a while.
6,
Well,
7,
that-
8
What
years, I think.
astounds me is he
But-
didn't take his success to Janice.
That's a testament to leadership that's
Yeah.
still there, you know? So I agree, PIMCO's, I think PIMCO's the one.
Anybody else have any comments? If not, we need a motion.
Make a motion to switch from,
You got to identify yourself.
Justin Drew speaking. I make a motion to switch from Templeton Global Return to PIMCO Diversified Income Institutional Shares.
Thanks, Justin. Do we have a second?
Second the motion.
We have
John
a sec-
Briggs.
John Briggs seconded it. All those in favor signify by saying aye.
Are we
Aye.
going to look at any other alternatives or no?
We certainly can.
Well, I mean, you said you're going to look into,
Yeah, I'd be happy to see. Candidly, I don't know how feasible it would be, but I would be happy to look into it. Because I would think with a strategy like that, they may be specific as to size. And it may even be something we would have to have Ken take a look at,
yeah.
just due to the structure and kind of the underlying.
Well, subject to that being an alternative or a viable alternative even, I would add my vote to PIMCO.
Okay. And I would submit, you do have the Credit Suisse fund that's next day liquidity as well. So if you ever, I think we could pursue both and you could look at that as an option as compared to both of those segments if you wanted to. If you didn't want to wait to move on today, if that makes sense. You have that other piece there and you could always look at other opportunities as compared to really both of those if you wanted to.
I'm in the same place. I think we should move on, but, so let me redo the vote again. All those in favor signify by saying aye.
Aye.
Aye. Opposed? Motion carried unanimously.
And if I may, Mr. Chairman, I have just one more item. The Eaton Vance Atlanta Capital SMID product that you all are invested in has an R6 share class. And it's about 10 basis points cheaper. It takes us from about 92 basis points to 82. So with the permission of the board, I'd like to switch you into that R6 share class.
Makes absolute sense to me. That fund has done really well for us.
Yep.
We need a motion to do that too, please, with a name.
John Briggs, I make a motion that we switch to the
R6 share class of the Eaton
R6
Vance
share
Atlanta
class.
Capital
the
SMID
Eaton
product.
Vance.
David Baird, I second that motion.
All those in favor signify by saying aye.
Aye.
Opposed? Motion carried unanimously. Thank you, Karen. That's great.
Absolutely. And that's all I had, unless there's anything else for me. That's
Is there any, I guess we haven't had a call yet, but have you heard anything more on the infrastructure?
Yeah, thank you for asking. I did mean to give you all an update on that. They have just done their fourth deal, which actually is, from my understanding, the sole network of pipelines in Abu Dhabi. And so now the amount of uncalled capital in the queue is about $1 billion, and they have about $3 billion in near-term pipeline opportunities. So I think within the next quarter or so, maybe by the next time we see each other, it will get called. It seems like they're picking up steam in funding that, in making purchases in that strategy. And I will tell you, it's brand new, so I want to be super clear about that. But for the last at least 3 quarters, they have steadily delivered a 2% return with income and then some appreciation. So they're off to that net 8% return that they estimated for us. Again, it's very early. They're a handful of quarters in, but they're off to a good start.
Good. Any other questions for Carrie? Thank you. We got a
Okay,
lot done
thank
this
you.
morning.
Yeah,
Thank
thank you
you.
very much.
Next is the experience study. Anybody need a 5-minute break or anything before we get into this? This will take a few minutes, I'm sure, more than a few minutes. Everybody good?
Yep.
Okay. Patrick, you're on. Welcome.
Thank you. Let me get one more little hand there.
Thank you.
Thank you.
So every year when I come and present that valuation report, we determine the city's funding requirements, and that's all based on our assumptions about the future. So periodically, you're supposed to look at all of your actual experience and say, okay, should we tweak those assumptions going forward? And that's the purpose of this study. If you go to page 3 and 4. So one piece of the valuation report is our unfunded actuarial accrued liability. And those are really where we've either had benefit changes and all of a sudden we have this new liability and we amortize that like a mortgage payment. And so the most of page 3 and the top of page 4 are a page right from the valuation report. And you can see there that we amortize gains and losses each year over 10 years. We do 10-year mortgages. If we do assumption changes or method changes, like we're talking about today, we would do those over 20 years. And if we do benefit changes, we amortize those over 30 years. And that came from a discussion with the state actuary about 12 years ago or something. And he felt like we were using 30 years for everything at the time. And he felt like that was pushing off to future taxpayers what the current taxpayers should be paying. And so he said, that's fine for benefit changes, but for assumption changes 20 and gains and losses 10. Well, you know, a lot's changed in the last 12 years or more than that. And so actuarial organizations looked at public plans and amortization schedules, and they basically found that like 15 years is a sweet spot. Because those 10-year amortizations for gains and losses, they produce a little more volatility. Because you got a high payment for 10 years and then it drops off, or a negative for 10 years and then it goes up. And so 15 years is a little more stable, and then you're still not pushing off to future taxpayers. So our recommendation is for all future bases, we'll use 15 years. That was the first thing that we talked about in the study. It doesn't change anything about the past. We're not going to change any of these. We're just going to change it going forward. And then investment return assumption is probably the most important assumption that we have in the report. And so your real history there is on pages 6 and 7. And it was pretty nice when I did this study, because if you look from October 1, 1987 through September 30, 2019, so that's 32 years of experience there. The average has been 7.8%. And your assumption right now is 7.75. So that's a good thing to see, that over that long period, that's actually what you've gotten. But now, we talked about the low interest rates when Carrie was talking. And, you know, with those low interest rates, we're not expecting to get much out of our fixed income for an indefinite period of time. And so most boards are trying to gradually reduce that assumption. Now you can see you guys went from 8% down to 7.75 about 5 years ago. And so our recommendation is that, especially since there's some other things in here that will help, it might be a good time to try to lower that a little bit more at this point. And so if you go to the very last page of the study, page 18, if we think we're going to earn less going forward, then we're going to need to put in more contributions, right? And because the benefits aren't going to change we're gonna pay the firefighters what we're gonna pay the firefighters. And so if we change to 7.5, that'll increase the city's funding requirements about 78,000 a year. 7.25 would increase it about 159,000 a year. And our funded ratio would go from 88.8% to about 86.3 or 83.8. And so just keep that in mind as we're going through the report, and then we'll talk about it again at the end. Page 8 talks about salary increases. These are individual salary increases. And we have historically just had a 6% assumption that each year, each firefighter will get a 6% increase. And that was based on inflation of, say, 3%. And then each time you get a promotion, you'll get a bigger increase. And that's where the 6% came from. But really, as you know, salary increases have not been very significant for an extended period of time. So in this study, we looked at the last 10 years of experience. And at the very beginning, people get bigger increases, partly probably because of steps and things. But also when someone gets hired, we ask the city for their salary. And a lot of times, it just happens that they underestimate that. So we've found with all of our clients that the first couple of years have bigger increases. So yours have been actually 14.6 and 9.8% for those first 2 years. But then after that, you've been at steadies, 3.7 for 2 to 4 years, 4.1% for 5 to 9 years. So basically, your average has been around 4.5% for the last 10 years, and our assumption is 6%. So I think we can lower that a little bit. I mean, I think it's been artificially low, probably 10 years, because the 10 years before that, they were real high after 9/11 and stuff. And so our recommendation is that we go to 10% the first 2 years and 5% after that. So we're basically changing our assumption for the most part from 6% to 5%. And so if you do that, then your projected benefits at retirement are lower. So lower salary increases means lower benefits at retirement. So we can contribute less money. We can contribute, the city's costs will go down by 88,000 a year if we make that particular change. And then if you go back to the first page we looked at, pages 3 and 4. The other thing about those mortgage payments is we have a payroll growth assumption right now of 1.34%. And so basically, if we pay $1,000 this year, next year we're going to pay $1,000 plus 1.34%. And then each year it goes up a little bit. And the idea with that is that if payroll goes up each year, then your mortgage payment represents about the same percentage of payroll. But with payrolls all over the place, our recommendation is that we just go to flat dollar amortizations, just like your home mortgage. You pay the same amount for the whole 30 years. But if we do that, if you go to page 10, that shows you one of those particular mortgages that we have, the 2004 base. And the left-hand side there is the current amortization schedule. So we're paying $100,000 this year. Next year we'll pay 102, and the next year 103. So you can see where it goes up a little bit each year. The right-hand side is what we're proposing. So it'll just stay a flat 108,000 every year. And so that increases the cost right now, but you're going to save interest in the long run. And so the bottom of page 9 shows you that the city's costs would go up about 17,000 at the current point if we do that. Now we get into the demographic assumptions and mortality. Remember, we have to follow whatever FRS does for the mortality assumption. And they actually just changed last year their assumption. And they did that because the Society of Actuaries did a study of public employees' mortality, which obviously is great because that's what we are as public employees. And that actually had a little higher mortality than the old numbers that they were using. And so if you go to page 13, when we make that change next year, that's going to decrease the city's funding requirements by $30,000 a year. So that helps the funding requirements. And we don't even have to decide anything on that because it's mandated to us. Pages 14 and 15 talk about retirement rates. That's when we think people are going to retire. If you go to page 15, right now you have early retirement at 45 and 10. That's when somebody can retire under early retirement. And then your normal retirement is age 55 or 25 years of service. And so, in the last 10 years, we've had 6 people retire. One of them chose early retirement at 48 and 22, and the other 5 did normal or drop. And you can see that 3 out of the 5 took it right at first eligibility, and then the other 2 waited a little bit. And so our proposal, if you go back to page 14, we're going to, for early retirement, our assumption has always been 2% chance each year. And that's really kind of what you've had over the last 10 years. So there's no reason to change that. But normal retirement, we had 100% at first eligibility. It was our assumption. But you can see that not everybody retires when they're first eligible. And so our proposal is to say, when you're first eligible, there's a 70% chance you're going to retire. And then a 50% chance the next 2 years, and then 100% at 3 years after normal retirement. And so that, if we think people are going to wait to draw their benefit, that actually helps the plan. So the funding requirements go down by $30,000 a year if we make that assumption change. We only got one more left here, and that's the turnover rates on page 16. And that's the people that terminate before retirement. And so we have an age-based assumption right now. Younger people terminate and move on more than older people do. So that's our assumption right now. And when I looked at the actual experience, in the first 10 years, that's lined up pretty good. But once people make 10 years of service here, you've had 0 people terminate non-retirement because they stay till retirement. And so my proposal is to keep the same table we have now for people that have less than 10 years of service, and then assume only a 1% chance each year once they reach 10 years of service. And so that one has the opposite, because all those people that make it to retirement, that hurts the plan. And so if we change that assumption, it'll increase the funding requirements by $33,000 a year. So then if we go to the very back page again, that kind of summarizes everything that we just talked about. And so if you look at number 9, line 9 there, basically that says, well, if we keep the assumption at 7.75 and we make all those other changes that I talked about, then the city's costs will go down by about $112,000 a year. And if we change to 7.5, the city's costs will go down about $36,000 a year. And if we change to 7.25, the city's costs will go up about $41,000 a year. And then while I was sitting there, I was looking at your asset smoothing. We use that 4-year smoothing technique, and we basically just say, we look at the average return over the last 4 years. And that's what we've done for all of our clients for a long time. But we've found that it does have a little bit of a drift to it. It doesn't provide perfectly stable results. And so we'd like to fresh start our clients and then do a different smoothing technique going forward. And if we do that, that'll help the funding a little bit when we do the 10/1/2020 valuation report. Probably about $28,000 a year savings by doing that. So basically, you may want to consider going with line 11 or 10, or maybe somewhere in between, where you do all the assumption changes we talked about for mortality, turnover, retirement, and then you lower that investment return assumption to 7.5 or 7.25 or something in between. So now I just wanted to open it up for discussion by the board.
Wow.
I know it's a lot of information.
John Briggs, first thing I'll say is, as far as the raises, the current contract, we can get 6% a year. 3% education and then 3% step. Now, will that, it hasn't been that way in the past. Where we go in the future, we don't know. But I don't know if it would be foolish to change that when that's what we are currently in. But you looked out over the previous years and show that it's way down. So, I just wanted to throw that out there. I didn't want to go into it saying we expect to get 5% or something when right now, if a guy turns in his education and whatnot, he can get 6.
But then again, then there might be some people that don't do any.
And some people don't.
So maybe that's,
But they would still get a 3. Yeah, so
So
that
what do
kind
you
of puts
mean
you
by
back.
education?
If they take classes, 2 40-hour classes, or get a certificate from the state for taking the classes and turning them in,
So if they do that each year,
they'll get an extra 3, so they'll get a total of 6. 3 step and then 3 for education.
I see.
And all that can change, and that's just kind of what the firefighters put in the contract the last go-around to kind of keep us competitive with the other
And then
agencies.
if you got promoted, you would get another increase.
Yes, yeah.
Well, then, we could just leave the salary increase assumption at 6%. That would make sense with what you're telling me. We want to look at what we think's going to happen in the future.
Right.
And the past is a good indication, but it sounds like we know that it might be around 6% going forward.
But that assumes that 100% of the people are going to do their educational.
Right. Which I'm not sure, maybe 75, 80% actually turn them in.
you think
Well, and if 75 to 80% do that, and then people get promotions,
Right.
that's going to get you to that 6% anyway. It's better to be conservative anyway. You don't want to assume 5 and have the answer be 6, because then every year when I come and present the report, I have to say, oh, we had a loss
news.
this year and the city's costs are going up. We'd rather be on the conservative side than the aggressive side.
yes.
I think the history is real good, and I think that what you're saying is good, but with some new input, I think the 6% may make more sense.
So then, like, if you did number 10 there without the salary increase, then the city's costs would go up, around $50,000 a year. But we could cut about half of that off when we do that fresh start on the assets smoothing this year. And the other handout I passed out is all of our plans we look at each summer. The last time we did it was last summer. Look at all of our plans and the assumptions they're using. So you can see on that sheet that the average is right about exactly 7.5% of all of our plans in Florida. So if you guys went from the 7.75 down to 7.5, at least you'd be lining up with the average of all of our plans.
I know you are proposing this new smoothing. Do you have a thought as to where we will be? I realize there's 2 more weeks left, but what would the new number be? What would our results be with your new flattening for however you're going to do that? Like in the past, it's been the flattening of 4 years, and we've been doing that 7.5, 7.75.
Well, what's going to happen if we can hold out the next couple of weeks, if we get a 10% return this fiscal year, let's say, I looked at it, and with the 4-year smoothing, we would have about a 10% return on the 4-year average, because the last 3 years have averaged about 10%. And so you're going to have a gain in the plan just because of that. That's going to be a positive thing when I come back, in December. But then also, right now, the actuarial value of assets is $15,295,000, and the market value is $15,590,000. And so we have about a $300,000 cushion in there right now, and that'll stay about the same, probably be about another $300,000 cushion when I do the 10/1/2020 valuation. So that's what I'm saying. If we fresh start and we say, okay, let's just start over at the market value, and then we'll smooth going forward, then you're going to get a gain there of about $300,000. So you're going to get a gain just because of our good returns this year, and then we're going to get an extra gain by fresh starting those assets. So it's going to be a good report when I come in December.
If our returns are doing so well, then it's hard for me to understand why we would reduce our assumptions, because that makes the taxpayers pay more money into the fund. I want the
Well,
fund to be
I
whole. That's our
I think
job.
if we're ever going to do it, we should do it when we have a surplus, and we're not going to ding the city.
Exactly.
By making the move.
This is actually the
So-
perfect time to do it, because what happened in the last time we had a recession, or in 2008, when we had that, well, what happened is that everybody was using you were using 8%, and some plans were using 8.5%. And so all of a sudden the market crashed in 2008. And then all the plans were also looking at, well, hey, our assumptions are too high. So they had to lower those assumptions. And so at that time, we had bad experience in the valuation report. And then we had to lower that assumption, which made it worse. So this is the perfect time to do it when we have good experience, and then it balances that out. But also the other thing is that when the, as you know, everything levels out. So if the markets goes high, that's the time, that it's probably going to come down. So we've had really good experience lately on the investments. And so I would say that's the perfect time to say, well, let's lower our assumption for the future, because odds are we're going to come back down a little bit. So I think the timing is good right now, from my perspective.
I would favor that too. I mean, I think, what we did, we were put in a position of if we went to a more realistic annual return assumption, the city was going to have to cough up a whole bunch of extra money. And we chose, because of the buoyancy of the market and the fact that markets were going up and down 1% a day, how we were going to adjust like a half of 1% on our annual return and cost the city a lot of money. So we came to the conclusion that better just leave it alone and not cost the city at this point. We're now in a position where we can actually make that move and not cost the city anything. So I think the more conservative, I think, as you point out, more conservative we are, the better.
I agree 100%.
Well, and 7.5 isn't even all that conservative.
No, I understand.
Because FRS, Florida Retirement System, they actually went from 7.4 to 7.2 this year. So their assumption is 7.2%. So you'd still be more aggressive than the Florida Retirement System.
And the problem we've got is that we are regulated as to how much bond money we have to have,
Yes.
and we're getting virtually nothing out of it,
Yep.
or very little out of it, way below 7.5%.
Right.
So we've got to compensate in other ways, and we've done that successfully by upping our equity exposure and by real estate. And real estate, by the way, has been returning, even in bad years until this year, has been outperforming the 7.5%. So I think I'd be in favor of doing it so long as whatever the net result is after all the changes is we don't give the city a new bill that they've got to cough up. Because they're going
Well, it
through,
may-
their revenue's got to be through the floor at this point too.
It may end up with a little bit of an increase. You know, right now, my guess would be about a $22,000 increase. If you made all those changes with the 7.5. I mean, which is not that significant, but I don't want to say that there'll be zero increase, because there might be a small increase to the funding requirements if we did all that.
I mean, I would really,
But
I would really,
also-
given the position of the city at this point, the fiscal condition there, I would hate to hand them a new bill.
But also the regular experience of the plan, remember, I think we're gonna get a reduction in the funding requirements with the 10/1/2020 evaluation. Just the regular, because we had good investment return and the regular experience, so maybe it would be a wash to the city.
Yeah, I mean, if it's a wash or the benefit, I'm all for it. If we're just going to simply hand them an increased bill, I'd be reluctant. I would do it, say, a year from now when potentially the economy's recovered a bit more and they've,
Well,
Got more flexibility.
You could make a motion, I could do this. I could change the assumption down to whatever level so that the city's costs stay the same with the 10/1/2020 evaluation. I could do it that way.
Yeah, but then we're lining up to give, we're making our assumption based on what we want them to contribute. That's not really what the assumption should be, should it? It should be what we assume we're going to get in return.
Yeah, I mean, ideally, you're right, but in practicality, you do have to consider the impact, you know, that it's going to have on the city. So you're right, idealistically, we shouldn't even care. We should just say, what do we expect for our investment return long-term? But I think it's reasonable to say, well, we want to lower our expectation. We don't know exactly what that number is going to be. We don't know exactly if it's going to be 7.5 or 7.4 or 7.6. And so we're saying we want to lower that, but in the current environment, we don't want to have a big impact on the city.
yeah.
So I think it's okay. You're right. Ideally, we shouldn't care, but practically, I think we do need to consider the impact on the city.
Well, it doesn't sound like it's going to be a big impact this year. And I
No.
don't think there's a financial issue in this budget this year. Next year, there'll be a whole different story, because the state has lost so much money. Well, that funding won't really change until we move forward. It
Yeah.
kind of drags behind. So I think next year you'll see the city in some real financial strait where they're gonna have to look at.
Next year, starting November or what?
No, the next budget. They'll be okay. They already got a budget and they've got the funding for the budget, you know.
For which year?
the
From
next
when to
year's
when?
October to,
October 2020 to
Yes.
October 2021?
yes, for the year going forward, yeah.
So the real problem is going to be in
If there is a
Well,
problem, I
22.
assume there's going to be, because this, you know, the state has, I don't know how many billions of dollars they're short, but, and that hasn't hit yet, that hasn't happened yet, but it will in their next budget. And they have to balance the budget, so, as the city does. So I think that's when you'll see a little change, I think.
I just hate to add to the problem, that's all.
Yeah, well, me too.
Well, then I think you guys, if somebody wanted to, I mean, we can keep discussing it, but if somebody wanted to, you could make a motion to do all the changes with the 10/1/2020 evaluation report. Make all the changes in the experience study except for the salary increase assumption. And then we're gonna change the investment return assumption down such that the city's costs stay the same in the 10/1/2020 evaluation report.
Yeah, stay the same or go down, whatever the number turns
Right.
out to be.
Well, no, I'm gonna lower that assumption as much as I can so that it stays the same, you know, but it won't be less than 7.5.
And then you'll have that for us at the next meeting.
Yeah, when I come in December and you guys get that report, it's gonna have all those changes in it. And then it's gonna show the city's costs staying the same. You know, every year I come and tell you, oh, city's costs are going up or down. This one, the city's costs are gonna stay the same. We're gonna change all the assumptions and we're gonna change the investment return to figure out exactly so that the city's costs stay the same.
Well, I think that would be a plus, a positive.
Yeah, and we also don't want the city's costs to go down too dramatically either. That's what happened to us back 12
Right.
years ago or so when they put in nothing.
Yeah.
Because the market was doing so
Right.
good, and they said, well, we don't need to put in anything, because that's what
So then they
told
find
us.
new things to
So
spend
they
money
didn't
on.
do anything. And then then we were in big trouble when the recession came. We would have been much better. Now we have that fail-safe with the 12%. So,
Well, then I would make a motion, David Baird speaking, I would make a motion to do what has been suggested. Providing that there's no negative.
I second. John Briggs.
any further discussion? Not all those in favor signify by saying aye.
Aye.
Opposed? Motion carried unanimously. Thank you, Patrick. That was some really new, innovative ideas.
Yep,
And Leah, if you're listening, I'll send you that in an email.
Yeah, right.
yeah,
Yeah, nothing like saying a motion for what you said.
yeah.
Okay, we have budget and fiduciary, so we still have a few more things to do, and now I need a 2-minute break. So if anybody else needs to, you bear with me, I'll be right back. Oh, put on the mask.
Yep.
Yeah, I guess we're gonna computer, right?
Smoothing techniques, taking more years, or how's that work?
It'll still be a 4-year smoothing. It'll just be slightly different. It'll take each year when we have a gain or loss. Let's say we have $100,000 gain each year. We'll recognize $25,000 that first year, and then $25,000 the second, $25,000 the third, and $25,000 the fourth. And that way, you can't do it. It's always just deferring some of those gains or losses for a 4-year period. It's really essentially kind of the same thing.
Right.
Just mathematically, it's a little more.
This is the fourth quarter off the last 0% return from 2015.
Well, you had already dropped that. Here's the full year from this last report. So we did, what we will be doing is, let's say in 2021, we have a bad year. Well, we would have had some gains stored up. We're kind of recognizing right away whenever the 2020 valuation fresh started.
Really expecting a 10% commission.
Well, she said for August 31, we were at 14.
Yeah,
Right.
August 31 was like 15.6. We've probably given, I don't know, a little less than a handful of that back, but.
You'll be okay, right?
Yes.
So depending on the last 2 weeks, I mean,
I've seen her, I've been on the board off and on. I've seen her.
when I was thinking about it, you guys are.
Skinny enough.
Sorry.
Not enough.
Good thing you were skinny, huh?
No, I'm not skinny.
You know, I mean, the average of our.
Crazy.
That's police, fire in general. And fire is usually the worst, because you guys all work. And so, you guys are in great shape here.
Here's 145,
Okay, we're back in session. Next on the agenda is expense report. John?
All right, you'll see before you two papers.
Yep.
One of them has the administrative budget expense report for 2019-20. And you'll see the budgeted amounts that we budgeted for each category on the left side. And then the middle category was the actual expense for this year. And then so I did amended budget on the right side that'll reflect what we spent. So I guess I'll need a motion to accept the amended budget.
Motion to,
Written.
motion to accept the amended budget?
Name. Your name?
Oh, Justin Giroux. Motion to accept amended budget?
Jared Jones, second.
All those in favor signify by saying aye.
Aye.
Aye. Motion
And the
carried unanimously.
second paper will be our budget going forward with this next year. And I left it blank so we can just have discussion to see what we want to put in these categories. And I have all the bills and stuff with me if anybody wants to see them. You know, it was a heavy year as far as the actuarial expenses.
Why was that so much above budget? Do you know? Is there a reason?
Was it the experience study?
No, the experience study's in there, but I think it's really a lot of the state mandates and the hoops they have to jump through now with all the new reporting. And then most everything has to go through the attorney that we do, and, but I don't really know why such a big jump.
But the attorney's fees also went up 2,300.
Yes. Yeah, and everything, I mean, I'm really not in much control of that.
So it's not a one-time phenomena? They have to just repeat this year after year after year?
We just use them as we need to.
Let's go back to the actuary for a second. So we budgeted 16, but we did that experience study this year, which we don't do every year. And wasn't that $7,000 or $7,500? That would have made that 23, the actual?
The experience study. I don't see the experience study on. 6, 11, 29, 19. Yeah, because the last bill I got from Foster & Foster is from 3/26
So,
of 20.
so then.
So the
then
experience study isn't on here. We had, the actuarial variation report for last year is 8,000. The, Chapter 112 compliance disclosure, 3,500. The GASB 68 statement that the state requires, 2,000. GASB 67 statement, 1,200. I'm gonna have, this bill alone here is 16,000.
So that was the
And
whole.
I got that, 12/6/2019. So it
And
was
that-
early last year.
Yeah, and that's what it actually was.
Yeah.
But this is like 45% higher, yeah?
Yeah, and I think,
Plus, we haven't paid for the experience study, so that, this number in the next year's budget, if that's this year's, next year's, there's $7,000 more, or
Yeah,
75, whatever it
there's
was.
no-
So
right.
that's really, that number's gonna be 30 for next year.
it very well could be.
I mean, that's a hell of a lot of money to pay for,
Yeah. I mean, a lot of this stuff, I know we don't have any choice, as John just said, which is, but it is all money that comes right out of the fund, which is,
yeah. I mean, it's hard to believe too, with Washington cutting regulations hand over fist, that suddenly Florida is increasing regulations and requiring more reporting.
I don't know. I can't
I mean,
answer
that's
that. Yeah,
counter
that's-
to what you
that is
would
interesting.
expect.
Yeah, that is interesting. Unfortunately, it's kind of one of those, it is what it is, so. So what do we want to do with these numbers, folks?
Well, I mean, what disturbs me is what you said, we're gonna assume that the $7,000 increase is permanent and that added another 7,000?
I don't know, I mean, was there anything that you saw in there that caused the increase from 16 to 23, or just routine stuff, or we didn't do anything?
No, I mean, we did, the way the bills rolled in, so like this bill I got 11/26, and it has the previous year's compliance disclosure on it, $3,500 for 2018 compliance. And then I also got the 2019 compliance on 3/26 for this year, that's another 3,500. So this
So one
one,
year's cost went on the other year's budget.
yes, this one, this year we paid for last year's also.
Oh, okay.
So that's 3,500 less. Moving forward, we should just be paying for 2020s.
Maybe it would be,
That would be 3,500 less.
maybe we should ask Patrick to give us a forecast of expenses instead of us guessing what he's gonna bill us. Maybe he should,
He knows what's required by law.
yeah. And then
He
we'll-
also knows what the experience study costs or whatever, when that's gonna hit us.
Yeah, we do that.
We should be able to get a pretty accurate picture from him, rather than guessing ourselves.
Yeah, I would think that'd be fair. And then, of course, this year will be that exception because we have the experience study that we have yet to pay for.
And see if he's out there.
I think he's on with the general pension, but he can probably come back in again. Well, let's move to attorney then. Anything unusual there that would not be reoccurring, or is this, you think it's just, that's the number?
And you know, this is the highest it's ever been. And just a lot of this stuff that Patrick does has to go through the attorney also, and vice versa, with the different ordinance changes and.
Hey, Patrick, we were just working on our budget for next year, and you were at the top of the budget. And we had budgeted $16,000, and our actual expenses, John's telling us for this fiscal year was $23,436. But we don't think we paid for the experience study yet, so we're trying to budget money for next year, but we're wondering if you can help us with what it is we do each year, what you need to file each year, what.
Well, you don't think the experience study was in there?
Yeah, I know.
He can't find it.
The last bill I got from you was, $325.
Do we have a printout of every cost, or are we just kind of piecemealing this together here? Because it seems like the experience study should be in there already.
Well, I mean, I just finished it yesterday, so certainly it might not be on there. Usually it's a delay. So
Yeah.
Let me look at this.
We're just trying to figure out what are reoccurring costs
Yeah.
to move forward with and what might be one-time costs. And I did see in there where I paid 2018, this last year's evaluation, and 2019's.
So it was
that-
doubled,
Right.
yeah.
Well, while Patrick's doing that, why don't we move on to attorney and, so you,
I mean, I think you could do, yeah, I think there was more because of the delay. But this year, there's gonna be an extra 7,500 because of the delay from the experience study. In a normal year, the valuation, the GASB statements, the 112.664, and the share plan, all that would probably be about, and then there was some drops and some studies. That would have been about 18,000. So I think you should budget about,
25?
well, might as well budget 30. You're not gonna use that much, but you just don't wanna go, there's no penalty for over budgeting. But if you budget too little and then you spend more, you have to go back and amend your budget.
when you say the 18, you mentioned there was a couple of studies in there. That wouldn't be recurring costs, that was just something special.
Well, you just never know what's gonna happen. I mean, the attorney might say, well, we're gonna do an ordinance to do something, and I have to do an analysis. So, to be safe,
Yeah,
normally 20,000 would probably be a safe budget,
But we got the,
but you have the experience study in there.
okay,
Thank you.
thanks, Patrick.
so what did we set it at?
Well, we didn't, so we're gonna talk about it. So if 20 would be, well, last time was 18 with those couple of studies, so maybe that's the number. So we still have to do the experience study, so we're gonna be 27 to 30 for this year, for next year, because of
But
that
that's a one-time,
one-time deal. Well, one time every 4 or 5 years.
I would say 30, and then,
Is it 30?
like he said,
I guess, that's,
yeah.
I mean, we're only gonna spend whatever we need to spend. It's not
Right.
like willy-nilly, it's just gonna.
Exactly.
Okay, how about the attorney? So that, we spent $3,300 more, $2,300 more than we budgeted. Was there anything there that's,
and again, that's 20% plus. I mean, 40 and 20 is.
yeah, yeah,
And I know the attorney's got another ordinance change going to be coming out with the Secure Act that I'm not sure what all that entails or anything, but some Secure Act pension ordinance change that he's going to be bringing forward.
Do we have any idea what that'll cost?
No. I don't know how much work they're going to have to go into it, and he'll be at the next meeting.
Well, do we have to decide this today then? Or could we wait until December? Have to decide today?
I don't see why we have to decide today.
no, we probably don't.
I think it has to be in by a certain time.
We can always amend it,
Yeah.
but it's kind of the same.
We could decide now and amend it, speak to him, or we can just set it and,
Well, why don't we just put 15 there and talk to him and amend it if we have to?
Yeah.
sounds
Yeah, and
good.
we can always be under budget. I mean,
Yeah.
again, it's not like we're buying things that we don't need or whatever, so. Why don't we leave insurance blank for a second? We'll go on to that insurance thing when we're done with this, and then we can decide about that.
Okay.
Consultant stays flat.
Why is that? Why is that?
I don't know. What is what, the insurance or the consultant?
No, the consultant, I mean, why did they not increase their fees?
I don't know. Is that,
I mean, typically they take a percentage of the money that you're investing or something of that
No,
ilk rather
no, they're
than,
not a percent, they're a
they're
flat
just a flat fee?
1625.
Well, that's wonderful.
Yeah, sure.
a month.
yeah, it really is. That's pretty, okay, so we'll leave that as it is. Custodial, remind me again what that is, John?
Salem Trust.
Yeah.
Oh, right, thank you.
It's a
And
new
they're-
name now.
Thank you.
They're a basis point.
Thank you. Okay, so that would probably, we can remain at 10?
Yeah.
Yeah.
And travel and education, we'll leave as it is, and if anybody wants to attend anything, then we have the money to do that, and if not,
See, people aren't spending money on education. So that 6% deal isn't coming through.
and miscellaneous, doesn't look like we spent any money for miscellaneous.
No.
No, I don't think we will.
It's good to have it there, though.
Yeah.
Do we need to, should it be?
Well, I
that?
mean, I think it's good just in case we do have to use something. It's budgeted.
Doesn't hurt.
Doesn't hurt.
And if we don't have it, if we don't use it, doesn't matter.
Okay. Well, let's pause for a moment, then, and let's quickly go into this insurance crap. This has now been 1 year. For this freaking thing. So I sent you all an email yesterday. It probably didn't make a whole gang of sense, but this is the fiduciary insurance. We had Travelers, just to refresh your memory. We still have Travelers. We had it with a private broker. We've since shifted it to the Public Risk Insurance Advisors, so now they have all of our insurance and not this fiduciary thing in another place. So we finally got all the paperwork done, and just yesterday, she got 2 quotes for us, one of which was Travelers. A couple of interesting points before I just talk about the dollars here. The gal that we deal with, her name is Melanie, and she handles 48 municipalities of some sort, cities, housing authorities, whatever. That's her role in this thing. Only 2 of them have fiduciary insurance. She said, I don't really know a lot about fiduciary insurance because nobody has it. And I said, really? She said, nope. She said, they just don't have it. And she said, you would be number 3 that I have out of 48. And I just thought that was kind of an interesting point. They just don't have it. So it's not exactly apples to apples, these 2 things. They're both for $1 million. Not in any particular order, but I noticed when I looked at the 2 comparisons, Travelers is called an A++ rating, and Markel is an A. I asked her about that, and she said, we don't deal with anything less than a B+. She said, those are both fine. She said, Travelers is just a bigger company, and so I didn't think that was significant, but they're both $1 million. They have sublimits, and this is where it gets a little confusing. So sublimits means there's $1 million is the total benefit for all claims. For Travelers, it says the settlement program of liability is $100,000 for each notice. We take that to mean each claim is only $100,000. So if somebody sues us for $500,000, we only get $100,000. That's the way Melody and I interpreted this. And then they also have limits on HIPAA and 502C, which is documents and stuff, really wouldn't have any pertinence to us.
What's the 10,000? It's there.
The 10,000 is deductible. Yes, I forgot that.
So
So there's deductibles. So you're actually.
what does that mean?
Yeah, not much. So, and then there's Markel, who has only 1 limit of liability, and that's called voluntary compliance, and that has to do with internal revenue filings. I learned a lot yesterday in an hour. If you make mistakes in your internal revenue filings and you voluntarily tell them that you found these when you did an audit or something, if there's penalties or something, they cover you up to $200,000 in liability for that, if someone said that you did that intentionally or something. But for them, that's the only limit for liability. So again, we are taking that to mean that if somebody sued us for $800,000 liability, we would be covered for $800,000 or up to $1 million. Because that's,
May not be. Eh?
Yeah. The other difference is, they're both retroactive to July of 2003, so regardless of who, somebody came back now from, 2004 and said, the board then did this and it was wrong and we're gonna sue, whoever we sign with picks up that liability, even though they weren't our insurance company at the time.
But they're pretty sure that's not gonna happen, so why not?
I'm pretty sure.
Throw it in.
The only other interesting thing is the policy duration for travelers is 3 years, so when we get a price, we're locked in for 3 years. Markle is 1 year. Now, I asked her, so is that a concern? I mean, she said, no, not really. She says, that's just the way they do it. They just do the policy each year and you get a new, you get a bid, could be the same price or maybe not. So with all that gobbledygook, it's $700 less for Markle. 707 less. If you looked at this, I removed this, the waiver of endorsement each one has. Well, we don't pay for that, the city does. So I just took that. The actual costs for travelers, $35.08 and Markle, $28.01. So they're not exactly apples to apples. It's $700, which in the whole scheme of things is not huge. That's to the best of my understanding of what I just explained to you with Melanie's assistance.
Now, this is separate from, I mean, for example, you and I have both been on the board of the Underground Isle Civic Association. I've been on the board of the Animal Welfare League. We have directors and officers insurance. This is something different.
I believe so. I'm not sure I can answer that.
Because I know, for example, directors and officers insurance, which is like if somebody's embezzling or doing something purposely to undermine the activities of whatever you're doing, of the board you're on, you're covered for comparable amounts of money, but it costs a lot less.
Yeah,
Yeah.
a lot less.
Well, when
I mean, we're talking like $1,000, $1,500 for
it's-
directors and
it's
officers
minimal.
insurance.
Yeah, we have one at Kiwanis Club and other, it's about
But I don't know if that's
$1,000.
for liability or if that's just for insurance and
Well, then,
to cover the organization if you should embezzle something or something.
Yeah, but
Yeah.
the next question is like, why are there only three or why do only two have fiduciary insurance? I mean, what do they have in replacement? Are they insured some other way? Do they have directors and
I
officers?
actually called my insurance company. I have Hartford, and I have an umbrella policy with them. And I asked him that question. I said, so I explained to him, I sit on this board. I said, the chances of being sued are probably pretty small, but regardless. I said, so would that come under my umbrella cover? And the only question they asked me was, is it a volunteer board? And I said, yeah. And they said, you're absolutely covered. So that, again, I wasn't terribly worried about this. I didn't even know we had fiduciary insurance till we did the budget last year.
I've never even heard of that.
No, I haven't either. And I would like to talk to some other city and say, have you looked at this and why don't you have it? You know, like what's,
Well, they don't, the city here doesn't have it. The city council doesn't have it. I mean,
Yeah.
so you would think, if anything, the potential for a libel suit like.
Against
"You
the
made
city
this-
is much greater
you
than
made
the
this-
pension board."
You made this decision,
Yeah.
and now it's costing me more money in taxes, and we're gonna sue you for that.
Yeah. I do have to ask for permission. I do have to leave.
Okay.
I mean, this has gone a bit more than, and I have an engagement that I cannot get out of here.
Yeah, no, absolutely, Justin, thank
Do I
you.
get permission to leave here?
Yes.
Thank you very much.
Sorry it
Thank
went on
you.
so long.
Yeah.
Sometimes they do. And the other thing is, and we can start the whole process over again, but these are October 1st, so if we don't do it by October 1st,
we don't do it at all?
well, we can, we can do it, but we have to rebid it again.
Our current policy is good until July 1st.
Yeah, oh, and we're good,
Yeah.
we're covered. Our policy now is good until the travelers is July of 2022, so we're covered and we're good.
Okay, so let's, why don't we explore with other, or with the city, or even with other municipalities,
Yeah.
why they don't have fiduciary insurance?
I asked some of those questions.
And what do they have in
in the
place of that?
story.
How do they ensure their,
Shrugs like we don't have that. And it's like, okay.
yeah, how do they ensure their volunteer boards if not through fiduciary experience?
I
Insurance, I mean.
don't know. And I don't know, I don't know if all the 3 retirement boards have this or not either. I don't know.
Well, I'm sure they do or they did, because, I mean, I know it's nothing that I ever remember us just deciding we're gonna get.
Yeah.
We've always just followed suit with what was already going on the other boards. But I don't know for a fact.
Well, I don't think fiduciary insurance is a bad thing because, I mean, none of us want to be.
No, but if it's $4,000 as opposed to 1,500, then, you know, and we're not gaining anything particularly.
It doesn't appear like it. Actually, it sounds like Markle is a better deal.
Yeah, of the two, obviously. But do we need that even?
It's kind of like your own
Maybe-
umbrella policy. Do you need that?
But
Well, do you have to have it? Hell no. You know, but do you have it? Well,
Do we need to act on it today, or can we table it?
But we're covered till next July, right?
Well, we can table it,
Yeah,
and I just
for
have
your-
to have her redo it again, but it's not like we're not covered, but I don't know I'm not even sure who we would ask.
What about asking our attorney when he's here next meeting,
Yeah.
what his opinion is on it?
Ah. Very good, John. Perfect.
Yeah, he's dealing with all sorts of different,
Why
I
not?
mean, we could email him and ask him,
Yeah, I can,
say, why are we paying this if we obviously want coverage? None of us want us a liability because of
Yeah.
something that occurs that people say is wrong.
Why don't you just ask him to be prepared to answer that question at the next meeting?
Well, he could,
I'll email
can
it.
you give us an idea of what the alternatives are?
Yeah. Yeah, okay, I like that. That was a good idea. Good idea. All right, so we will table this ongoing,
I mean, from a budget standpoint, we can put $4,000 there and just say, we're
yes.
covered.
Yeah, I mean, well, we know we're covered for 3508. That's locked, we're locked in, so it's,
So let's put 3,508,
08 works, yeah.
yeah.
okay. So I guess we'll need a motion to approve the 2020-21 budget.
Did you make a motion or you?
Yes, I made a motion. John Briggs made a motion. We approve the 2021 fiscal year budget.
We need a second, folks.
Jared Jones, second.
We have a motion and a second to approve the next, budget for the next year. All those in favor signify by saying aye.
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 Opposed? Hearing none, motion carried.
And I will get a copy of it to Leah of the approved budget and the amended budget for her records.
Okay, there it is. Somehow in this mound of paper, I lost the agenda.
And you might even, well, I don't know, I guess we don't need to give anybody a heads up that we might amend these numbers based on the information
No, because we can.
we
just-
gain
can just put it on
between
the
now
agenda
and
amend them.
next year.
And we probably won't end up amending them anyway, but
Yeah. But we might, you never know.
we don't have any staff comments. Any comments?
Citizenship comments, yeah.
Oh, a citizen.
Holden Gibbs for record, Punta Gorda Fire Operations Chief. Just reading a little bit about fiduciary liability insurance. It seems that it protects the city, where director or D&O would protect you guys. So it protects more of the city against any liability.
Well, then,
Then it does.
thank you. That's just more of a question to ask Ken to have for us in December.
Yeah.
Because if we're buying this to protect the city, which was not my understanding, but it could be.
That may be it, so why is it
Why are
on
we-
there?
why are we paying-
Why are we
why
paying
are
for
we
it, not
paying
them?
for it? Yeah. Well, good. Maybe
And then
this-
does that mean that we should be looking at getting directors and officers insurance that we are not currently covered?
Well, I will also ask that to the public risk lady.
Well, I mean, or our attorney should answer that too.
Yes, absolutely. Yeah.
Because I wouldn't feel comfortable if, let's say, one of our investments just totally tanks.
It could. Hey, anything can happen.
Yeah, and we get charged for, it was an inappropriate investment. You know? You all made a bad mistake. You're responsible. You could have,
Exactly. And that was what the fiduciary insurance was to cover, but
Yeah, but it's not, what you said makes sense.
If Holden's right, then we've been carrying the wrong, well, let's find out for sure. We'll get that on the agenda and pre-warn Ken what we're looking for and talk about.
So you'll do that, John?
Yes.
Okay.
Any comments from you guys? Board member comments?
I'm just really happy with the performance. I mean, I think
Gosh, yeah.
we've come back strong, and that's great.
We've been doing well for many years, and I hope it keeps going. It's been wonderful, sir. Okay, well then I'll entertain a motion to adjourn.
So moved. David Baird.
All those in favor signify by saying aye. Aye. Motion carried unanimously.
Nobody seconded it. It doesn't
Thank
matter.
you, guys. We got a lot accomplished today and did some really good stuff, so. This is the longest meeting we ever had.